In this week's update, the correction lows are probably in, how to play Q4, and precious metals probably lower still. My name's Gary Davis, and as always, this is general advice only, and remember to subscribe and like the video. Increasingly, I'm getting asked a question something like this: who is going to win the US election, or some other related question to the uncertainty that we now face. And there is absolutely mountains of uncertainty. So it's understandable that I'm getting those sort of questions, but it's important to keep all this in perspective. So I want to put some focus on that this week. So my answer to who's going to win the US election is I have absolutely no idea, and I'd even go as far as to say I don't think it matters all that much to the market. We can't do anything about it with our investing, so trying to get an answer to that question is just a redundant exercise, because it doesn't really matter. We can't do anything about it. We can't know something like this in advance and modify our investing as a consequence. So if you're looking for some sort of insight or certainty as to how the next 3 months or 12 months plays out, then just forget it, because you're not going to get it anywhere. The answer is, the actions are found through a different pathway altogether. So what can we do in this sort of incredibly uncertain environment, and particularly the next 3 months leading up to and just after the US election? To my mind, the answer is to tone down short-term trading for a while, because the price action is going to become more volatile rather than less, and therefore it's going to become more random. And if you're trying to short-term trade in an environment where prices are just going down and then up and then down again, and it's largely, it's not trending, it's just random movement, then it's an incredibly difficult environment to try and make money in. So if you're a shorter term trader, I would really just try and back away from that for the time being and look for more medium term opportunities. And those medium term opportunities, the best ones exist in sectors that are going to be great over the next 2 years. And I talk about this most weeks, and I talk about it every day with the memberships, to try and get the focus on the areas where the greatest probability will be. I think the other thing that we can do too is to expect that volatility is going to remain elevated. If you have anticipated higher volatility in advance and how you will respond to that, then you're in far better shape than making knee-jerk decisions as the market flicks backwards and forwards. So there's some things that we can do that will help a great deal. So taking that a bit further, if you want safe investing, or so-called safe investing, then to my mind you don't get it through the traditional means of diversifying across all sectors. You go where the growth is, but you do need to be highly selective about how you go about that, because not all technology will work out, and also some of the technology stocks are just far too expensive to buy and gain some sort of probability advantage. And that's what trading and investing is about. It's not about certainties. It's about doing things that give you a significant probability, or significant higher probability of success. That's all it is. There's no guarantees. So if you're going to gain an advantage, it's very difficult to gain an advantage if you buy a stock that's just incredibly expensive. Now, as an example, Zoom is a tremendous company and a tremendous service, and it's going to continue to grow. But the price of Zoom is just off the charts at the moment, literally. So you wouldn't want to buy a stock, even though it's a great stock and it's probably going to be worth more in the future, because in the short term, the possibility of a very significant pullback is obviously there. So what provides the lowest risk of failure in the market? They're companies that benefit from the growth of the whole sector, and not just trying to pick individual winners. And I spoke about this last week and certainly the week before. So there is a tendency to try and pick individual stocks, but there are also, and there's nothing wrong with doing that, but in a period of even higher uncertainty, what we can do to improve our odds is to go for stocks that are going to benefit from the growth of the whole sector and not just an individual success. So the trick is to enter and manage so that you can psychologically accommodate the volatility that's inevitable. So it's not to stay out of the market because these opportunities are just too fabulous to ignore. But the trick is to stage your entries and manage, take partial profits along the way, whatever it is that you do, so that you can accommodate the volatility that occurs. And the more that you can pre-think the process, the better your decision making is going to be and the better your results are going to be. So let's turn, with that backdrop in mind, let's turn to the American market. Now the S&P ended up falling 0.6% for the week, down to just a tick under 3,300. But we did see a pretty handy reversal that occurred in the last part of Thursday and certainly was confirmed on Friday. So the question is, was the volatility of the last few weeks, was that just an unwind of the FANG trade, the massive call buying position that was built up and that just had to unwind? Or is it the election jitters, or is it any one of a number of a dozen other things? Again, I really want to make clear that it doesn't matter. Understanding what's causing it doesn't really matter. We just deal with what the market is giving us. Certainly the evidence that I'm looking at now, and I certainly identified the fact that we were probably going into a weaker period a few days before the market actually topped out and rolled over, and also did something similar in the precious metals market as well. And using the same evidence and the same logic suggests that the correction is finished to me. Now that's a probability statement only. It doesn't mean that the market couldn't have some sort of relapse if there was some sort of sentiment trigger. But certainly at this point in time, the evidence suggests that the correction is finished. And we'll look at the charts on that. Now, the reality in America is that despite what you might think is occurring over there, with basically gridlock in Washington, we've still got riots and civil unrest around the place. We've still got COVID at a relatively high level. But the reality is that business demand is accelerating, and it's accelerating at a steepening pace. That's the fact. Online retail is booming. The home building sector is booming. They're just not able to build enough homes to meet the demand. So there are many sectors of the American economy that are doing very well. This is not just about stock prices going up because of all this incredible stimulus. There is a certain underpinning of really solid economic fundamentals. Now the US dollar rose again, but this is really a euro weakness story. That's why the US dollar is going up. It's because the euro is going down and things aren't traveling all that well in Europe. So the US dollar was up and the yield a little unchanged, but it's just flicking backwards and forwards between about 0.65 and 0.7%. So let's go and take a look at some charts. So we'll start with the S&P, and you can see, and the thing that I really want to focus on is just the orientation of the moving averages. So the green line is the 20, the blue line is the 50, and the red line is the 200-day moving average. So look at the orientation of those and where the price is in respect to them. So you can see we've we broke the 50-day moving average through the week, or actually it was Friday of the previous week. And whilst we did get a nice recovery on Friday, we still finished net down for the week. But look, more importantly is the XLK ETF, because it's technology that's been leading for the last 5 years. It's technology that will continue to lead. And when technology does well, that's when the overall market does well. So this is the XLK, which is really where a lot of that massive call buying had to unwind from. And certainly it would appear that we're bouncing very nicely off this pretty obvious support level here around about the 110 level. and you can see it was quite a long candle on Friday night, finished almost right on its highs. So it was really quite positive. Now it's hard to see down here, but the relative strength against the S&P, which is this bottom pane, it's this second one from the bottom, did start to turn up in the last couple of days. So it definitely declined. We were seeing a rotation from technology into more defensive areas of the market, but that is now stabilized. And just in the last two sessions, the technology part of the market started to turn up relative to the S&P. So that's a positive. And also, we're heading into earnings season again in just a couple of weeks in the US. And the dynamic that we've seen a lot is that technology stocks rally into earnings season because the expectation is that their earnings are going to be better than estimates. So I think this is probably going to play out again. So generally there's been relative strength in the months before earnings. So that's another reason why I think we may have seen the lows there. Now, just on the concept of picking stocks that are going to benefit from the overall improvement in a sector or the overall growth in a sector, I just want to highlight one stock. Now, this is not a forum that I identify individual stocks in, but occasionally I do it just as an example to demonstrate the point. So this is a company, it's called Illumina, and basically they are in the sector of gene sequencing, so sequencing people's DNAs. Now, as we go forward, I think it's almost a no-brainer that this activity is going to increase substantially, probably exponentially, as the cost of genetic sequencing comes down. And it's come down a lot, and it's probably going to come down a lot further. Now, there are going to be winners and losers in that sector, but this company produces the equipment that does the measuring or the gene sequencing. So they're going to be a beneficiary of the growth of the whole pie, and not necessarily an individual winner. So that's what I mean by the stocks that are basically the picks and shovels of the gold rush. That's the first point. So I want to make 2 points. The first one is you can identify stocks where their growth is about as assured as you're ever going to get. Nothing is certain, but the growth of that sector is about as assured as you can ever get. So that's the first point. You can identify stocks that are in that position. The second point that I want to make is that inevitably there are periods of significant weakness that are generally short term, and we've seen one just in the last few days. So once you identify the stocks that you're interested in, just wait for a period of weakness. Generally, it's for a reason that's not valid, and in this particular case, the reason that the stock price fell from 360 down to 260 was just another piece of Wall Street nonsense. And so this is the sort of opportunity that, from a medium to long-term perspective, is should be very, very productive. Now, this is not a recommendation. This is just making 2 points. These type of stocks exist, and if you are on alert and monitoring them and you start to accumulate a position on weakness, then you can do very well. Turning to Aussie stocks. The Aussie dollar fell sharply. It was well over 73, fell down to almost 70 cents. The RBA certainly played a bit of a hand in that. They were obviously uncomfortable with how high the Australian dollar was going, and certainly their words about a potential tax cut, a potential interest rate cut, would have added to that situation as well. So we've come down about 3 cents. But as I said earlier, the US dollar up, Australian dollar down is really about euro weakness more than anything else. Now, our index managed to gain 100 points on the week, but it's still just stuck in this range around about the 6,000 point level, just a bit below, a bit above, but it's certainly not trending. And really, I've got nothing further to add than what I've been saying for weeks and months about the exciting local opportunities in small and mid-cap stocks. It's the number of opportunities is quite staggering. Very exciting opportunities. And also, too, a few weeks ago, I just ran through an exercise of showing the difference between owning the long-term accepted stodgy kind of dividend payers as the primary focus, and just thinking a little bit more broadly. So if you're a dividend investor, I'd really encourage you to broaden your thinking to high probability growth stocks. They may be paying a modest dividend now. They might be a CSL, or they might be a ResMed, or a stock like that. So the dividend mightn't look very attractive at the moment, but if you've got the growth, the dividend is going to grow, and history shows that occurs. And you're also going to pick up some pretty good capital gain as well, rather than a capital loss. So I'd really encourage dividend investors just to broaden your thinking to other sorts of stocks. If your primary focus is on the dividend and the dividend only, then I think that's probably going to end poorly. And it's ending poorly already. We're seeing it already with many companies cutting their dividend. So we'll just look quickly at the Australian market. So there's the ASX 200. We're still basically stuck at the same level we were at the end of May. Nothing has really changed. It's just gone sideways. Whereas we've obviously seen very significant recoveries in other markets around the world. Just a quick look at the currencies. There's the US dollar. So we've come down, trended down very strongly, formed a base. We're now bouncing. We're now back up to resistance, or what was support, which may well now become resistance. So it's possible that the US dollar may have run its course and may now start to head down again. But look, it doesn't really matter, to be honest. We just focus on the things that we can control. And there's the Australian dollar has come off as a consequence of what the US dollar is doing. Moving on now to precious metals. We got the breakdown that I'd been pointing to and concerned about for the last 2 or 3 weeks. Gold was down $90, finished down at $18.61. The support level broke as I indicated that it might. And on top of that, we now have, so we had a very strong seasonal period in June, July. There is another strong seasonal period coming up in precious metals in November and December. So this is all around the buying patterns, particularly in Asia. So we are now in this interim period where October tends to be the weakest month of the year for precious metals. So we've not only got a significant technical breakdown in the charts, we've also got seasonal weakness as well. So it's hard to see how we're going to get much of a sudden recovery during October. So I think we might have another 2, 3, 4 weeks to wait on this sector. Now, last week, US dollar gold fell by 4.6, but Australian dollar gold only fell by 1.1. So you're likely to see Australian gold stocks do a lot better than overseas gold stocks. So again, for precious metals, and this is short-term comment only, because if you recall back, people that watch this video every week, I pointed out all of the things that were perfect for gold, and that was a medium to long-term situation, and that still remains. So these comments are only about the short term. Now, technically, there could be another 5% move down in gold, and I'll point that out on the chart. And if that happens, and I think it's a probability that will happen, then we tend to see around about 2.5 to 3.5 times amplification in gold stocks. So a 5% move in gold could correspond to something like a 15% move in GDX. And it all ties in very nicely because it brings those both of those entities back to areas of likely support. And as I said, I think the local gold stocks they'll probably still have some downside, but it'll probably be fairly mild because the falling Australian dollar is shielding that drop in the gold price. So we'll take a look at the gold price. So let's look first of all at, let me look at let's look at the daily chart first. So this is what I said last week or the week before. I think it might have been last week. On the plus side, I said that we were holding key support and the 50-day moving average. But on the negative side, we had a descending triangle formation, and that sentiment for the sector was still uncomfortably bullish. And that's never a good sign when you've got this sort of pattern. I also said that the price was reaching the apex, so a bigger move was likely quite soon. Or the other alternative was that the price just went sideways and allowed the overboughtness, if you like, to be resolved by time. And I said that the 50-day moving average was a line in the sand. Well, the 50-day moving average got broken on Monday, quite emphatically, and then we've gone down very sharply and certainly didn't finish the week in any sort of positive fashion, not like stocks did. So the point here was that there would have been a lot of inexperienced traders that bought the breakout up through here, and they're not long-term investment buyers, and when the stock price or when the gold price broke down, then they would have been forced to flee. Now let's look at what is likely with the gold price. So we've bounced off the 38.2% level. It's likely now that we'll probably come down to somewhere around the 50% retracement level, which would also bring us pretty much to the bottom of this channel. And this is the trend channel that really started up in late 2018, that had been driving gold and gold stocks higher. So a pullback to the lower boundary there would make sense, corresponds to the 50% retracement. And if we look at so that level is around about 1760, 1770, that sort of area. And if we look at the daily chart, you can see that that also corresponds with the 200-day moving average. And it's also pretty close to these previous highs as well. So everything sort of culminates around about this 1760, 1770 area. So I think it's quite likely that we'll get a move back to that sort of area. So that would be the first point, that a 50% retracement to the 50% level on the 200-day is likely, and that represents around about 5% lower than where we are now. So I think that's the probable outcome. Now, if we turn to stocks and how that impacts stocks, this is GDX on a daily chart, where we're clearly pulling back now. We've got some key support here around $32, and the 200-day moving average is around $33. So I think this is the area, and that would be about a 12 to 15% pullback from where it is at the moment. And that all, again, ties in with about a 5% move in gold. So, yeah, it all just lines up rather nicely. So that's how I think the precious metals sector is going to go, and I would probably be pretty careful and cautious for the next 3, possibly 4 weeks in that sector. Now, turning to other commodities, copper slipped a little bit. That's really just currency effect. But look, there are several metals out there that are terrific long-term stories, and I've got a chart in a minute that I'll show you. So long-term, and I'm talking over the next 2 to 5 years, I think there's going to be some really strong outcomes in the base metals and some other metals areas, particularly associated with the electric vehicle market. And as I indicated earlier, rather than trying to pick winners, so the company that's exploring for nickel or exploring for some other metal, consider buying the picks and shovels businesses, because that lowers the risk and raises the probability. They're going to benefit from the growth of the whole sector, and it looks pretty likely that we're going to see very buoyant conditions for a lot of commodities over the next 5 years. If you just looked at one area in the battery metals area, then yes, you could pick nickel miners or you could pick graphite miners, and some of those are going to do quite well. But you could also go for the technology developers or the companies that are looking at building some sort of downstream value add facility. So those sort of companies, I think, are going to give you an even greater probability of success. Now, crude oil was down again to 37.28, and I just think it's a sector to be avoided. I'll keep highlighting what the price is doing, but I just can't see the probability of the sector getting back to buoyant conditions. So this is the battery materials chart. This is courtesy of an Australian company called Novonix, and it shows you what the total demand is from now through to 2030 for copper, aluminium, graphite, nickel, cobalt, lithium, and manganese in all these various areas. And I don't want to go into too much detail here, but just look at the demand as a whole for these sectors over the next 10 years. Or if you want to come in a little bit closer, look at where we are now in 2020 in terms of the total demand, and then look at where we'll be in 5 years' time. You know, it's about four or five times. So you don't have to go right out to 2030 to see an enormous surge, where there's going to be terrific opportunities in these particular areas. There's the spot copper chart. So we came off a little bit on currency, but it's obviously been trending up very nicely. And I think we'll look back in 2 years' time and we'll see that this is just part of a long-term uptrend in the copper price. So wrapping it up, things not to do. Don't sell when the market panics, because all you're doing is locking in a loss. You've taken yourself out of the market, and it's probably difficult to get back in again. So selling everything when the market panics is just not the way to go. It wasn't the way to go in 2008. Certainly wasn't the way to go at the end of 2018, and it wasn't the way to go in March of this year. So, you know, you've just got to step back and look at history to understand that doing wholesale selling is just not what you want to do when we've got these market panics. Because you've got to remember, we are in an overall secular bull market, and that market is going to keep rising over time. The second thing that I see a lot of people trying to do at the moment is I get questions about, is it a good idea to buy into a cruise liner company? Or is it a good idea to buy into travel companies? Or a whole host of other types of companies that are currently out of favour, people looking for turnarounds. Now, I know it's an enticing thought that you pick up some sort of turnaround and you feel great because you buy something that's out of favour and it goes up a few 100%. But the probability of you pulling that off consistently is actually really quite low. And there's not many of them percentage-wise that actually turn out. The other thing not to do is to worry about things that we can't control. We can't control the outcome of the US elections. So it's really, it's a redundant exercise thinking about it. Just focus on what we can control. So the things that we can do, we can identify the near certainties. Now again, nothing is ever guaranteed, but there are things that are highly, highly probable, and I've spoken about a number of them throughout this video. So focus on identifying the near certainties. And then we are going to get volatility. We are going to get disrupted markets. I think that's the one thing that probably is almost a guarantee. So build your game plan around the fact that we are going to get periodically disrupted markets. We are going to see periods like we saw in March and periods like we've seen just now. So build your game plan so that you can psychologically accommodate that. Because if you don't, it's the sort of situation that leads you to panic selling because you're just not sure what to do. So build the game plan with the expectation that every now and again we're going to get some disruption, and you need to know in advance how you're going to handle that. The other thing is to cultivate the ability to stand outside all the market noise. You know, there's just so much commentary at the moment. It's information overload, and most of it is wrong and misleading. So cultivate the ability to stand outside the market noise and see things as they really are. And that's really what this weekend video is about. I've been doing this now for about 16 years. almost every Sunday. And the purpose of this is to try and provide that perspective that allows you to stand outside the day-to-day market noise. So it's just so important. Portfolio analyst this week is really, now that it's likely that we've seen a turn in the US market in technology, then I'm going to be focusing on the great technical setups that we've now got, because the prices of some stocks have come down significantly. And these are great stocks. These are great technology picks and shovels stocks for the future. So that's it for this week. For those that want more information on my services, there's the website address and there's my email address as well.